Hello, and a warm welcome to our regular Japan Society webinar on current affairs and business. I am Bill Emmott, and it is my honor to chair the Japan Society. Thank you all for your support for the Society, and I hope the new year has begun well for you. Our topic today is a broad and big one: the prospects in this year of the tiger, both for Japan and for the wider Asian economy and markets. So it is sort of fitting that I'm chairing this webinar from a hotel room in Singapore, where I've been spending the week. By way of introduction, I will just mention some major political events in the coming year, which could have a broader impact on economy and business. Next month, the Beijing Winter Olympics will open without spectators, as in Tokyo's games last year, but also with a diplomatic boycott by some countries, led by the United States, symbolizing the geopolitical divisions that characterize our era. We also know that South Korea is due to hold a presidential election on March the 9th, which could be quite consequential for Korea-Japan relations. The Philippines will be holding its own elections on May the 9th, and although not an election, China is due to hold its 20th National Party Congress in the second half of the year, at which President Xi Jinping's third term in office is expected to be confirmed. Meanwhile, in Japan, the upper house election on July 25th will be an important milestone for Prime Minister Kishida. He needs to do well to ensure that he can stay as party leader for, shall we say, rather longer than his predecessor did, and to be able to implement his headline plans for a, quote, new capitalism and quotes, digital garden city vision, among others. All the while, we will also be thinking about the impact of COVID on countries with closed borders, such as Japan, China, and Taiwan, and in China's case, the impact of its zero COVID policy. And of course, we cannot avoid issues such as supply chain disruptions and inflation, although that inflation is notably far more of a European and American phenomenon than it is an Asian one. So certainly there is much to think about. To give us their views of the prospects for Japan and Asia, I am therefore delighted to welcome two very thoughtful and experienced observers, both brimming full of ideas and with positive thinking. In Hong Kong, we are joined by Jim McCafferty, who is joint head of APAC Equity Research at Nomura. Jim has worked in the region for more than a decade, initially at Royal Bank of Scotland, whose Asian units were then bought by a Malaysian bank, CIMB, and he then joined Nomura in 2015. And in Tokyo, we are joined by Jesper Koll, an economist and strategist who I confess, I have to say, to having known for more than 30 years, as he has been resident in Japan since 1986 and has held prominent roles at the likes of Merrill Lynch, JP Morgan, and Wisdom Tree, as well as serving on a large number of Japanese government advisory committees. He describes himself as Japan's last optimist and, fittingly, has become optimistically involved in a number of Japanese startup companies. As usual, I'm going to ask our guests to give opening remarks for a maximum of 10 minutes each, following which I will start a discussion and, most importantly, take in your questions. Please submit your questions at any time using the Q&A function. As we are the Japan Society, I'm going to ask Jesper Koll to open the proceedings, giving his view of the prospects for Japan. Over to you, Jesper, and welcome to the Japan Society.
Thank you, Bill, for having me, and welcome to everybody here. It's a very cold night here in Tokyo, but I hope you can enjoy the view of Tokyo. I am unashamedly optimistic on Japan. We can discuss perhaps in the Q&A some of the sort of specific investment ideas, but I want to, in these initial 10 minutes, just highlight a couple of points that are really important, because that is exactly where Japan is different from where Japan has been, over the last couple of decades. And the first point is the fact that, wow, we finally have positive wealth effects. You may have seen that just yesterday, it was confirmed that the real estate prices in Tokyo, the average apartment price is now above the peak that we had in 1990 at the peak of the Japanese bubble. So for the first time in one generation, we actually have positive wealth effects for the most important asset for the average Mr. and Mrs. Watanabe. And very interestingly, it's not just Tokyo, Osaka, Nagoya, Fukuoka. It's not just the 6 megacities, but you do actually see that positive wealth effects in terms of real estate prices are actually petering out into the countryside. As you are aware, COVID has been a positive catalyst in terms of changing entrenched work cultures, so that even companies like Hitachi, now basically looks for 25 to 30% of the workforce to basically work from home for 3 or 4 or 5 days, of the week there. So number one thing why you should be optimistic in Japan is that risk asset participation by domestic asset owners, namely the household sector, residential real estate prices are actually now creating positive tailwinds. The second point is a bit more macro, which is the reality that the yen, in the real effective exchange rate, you actually find that the Japanese yen is now as weak as it was in 1974, 1975. I mean, that's what happens. The nominal exchange rate has obviously depreciated, but if you've got this inflation differential with no inflation in Japan and inflation in the rest of the world, yes, the real effective exchange rate gives a tremendous boost in competitiveness for the industrial sector here in Japan. So that's sort of the big macro overlay. But why really should you be optimistic is the fact that the corporate metabolism, the private sector, is actually changing. The metabolism, I look at it in terms of M&A activity and in terms of venture capital activity. And as you know, for 2 consecutive years now, Japan has had record domestic M&A activity. So you do actually start to see industrial consolidation, even in, for example, the secondary banking system, with the regional bank mergers last year coming to about 12 of the 108 regional banks actually merging. And you see it in some of the other sectors, going through as well. The other one is the fact that, yes, a domestic venture capital ecosystem is actually being built. Now, look at the data. Over the last decade, until 2019, on average, Japan-based venture capital invested in about 800 startups. Over the last 2 years, 2020 and 2021, that was not 800, but 2,000 every year. There's a veritable ecosystem of startups actually coming through, and you actually see the fruits of this coming through. One big highlight last year, obviously, was the fact that PayPal bought the Japan startup Paydi, for about $2.5 billion. And I expect that this year, in 2022, you will actually start to see Japanese leading companies also beginning to buy startups as part of their new growth strategy going forward. Another point that's very, very important is that, yes, thank you, Prime Minister Kishida. You're doing exactly what Abe is doing, which is you're trying to shame Japanese corporations to pay higher wages. But actually, much more interesting is the fact that the scarcity of labor, the war for talent, is now changing the way leading companies are compensating their employees. You may have seen 2 weeks ago, Hitachi Corporation, which is not a little thing. I mean, that's the bastion of Japan. Hitachi Corporation is changing, to skills-based compensation, doing away with seniority-based compensation. And I think that this will improve the liquidity as well as the confidence in the Japanese labor market, and is a big change in terms of the way human capital is actually being deployed here. That's the private sector. Big pickup in the corporate metabolism, changes in the labor market, paying for skills, paying for job gata, changing for your expertise, paying for your expertise, rather than on the basis of seniority. Watch out for that to actually be a positive driver behind Japan's consumer spending. The final point is that, yes, what about politics? Now, Prime Minister Kishida, first of all, let's not forget, Japan is the only Western, or what should we call it, liberal democracy, where the government actually has de facto a supermajority of basically 2/3 control of parliament. They actually get things done. Yes, Prime Minister Kishida had to create a new slogan. After all, his predecessor, Mr. Abe, wow, Abe is in power, and after 1 month, they coined the term Abenomics. So Kishida has to break with that and comes up with this new capitalism. This is not about the redistribution. This is, very importantly, still a not formulated policy, but the committee that Kishida has appointed to actually create the hubs and the spokes and the policies behind the new capitalism leaves me very, very optimistic. Half of the committee is females, unheard of in Japan. And more importantly, the age of the committee is very young, and you don't have representatives from the Keidanren established dinosaur companies, but you actually have new entrepreneurs who've built successful companies who are now energizing the overall debate there. So I do expect that when the reports will come out by the summer, I do expect that, yes, we are going to see an added deregulation drive and pro-growth initiatives. We can discuss more in the Q&A, but these were the key points that I wanted to make. Watch out for the pickup in the corporate metabolism, and watch out for the way corporate Japan is paying for its labor. That is where Japan's dynamism will come from.
Fantastic, Jesper. Characteristically optimistic, but that I must say that the real estate flip over the 1990 figure in Tokyo is a very symbolic one, of course, to me and to all of us in many ways. And I think also the points you make about venture capital ecosystems and that committee of Prime Minister Kishida's are both things that start my heart beating a little bit faster, which is all to the good. So now I'm going to move to Jim McCafferty in Hong Kong to get your sense, Jim, of the drivers, the main drivers for Asian markets in 2022 and beyond.
Okay, well, thank you, Bill. You described Jesper as Japan's last optimist, so I guess I'm Japan's second last optimist. So we're quite confident at Nomura on Japan this year. But looking at Japan and looking at Asia, this cannot be done in isolation. As many of you know, Japan's companies are major exporters. And in fact, more than 50% of Japanese earnings come from outside of Japan. So looking at Asian stock markets, you've really got to put them into context with what's happening in the Western world. Now, a lot of the investors that we engage with, they have global mandates. So when they manage a pension fund, for example, they've got a choice of where that money is put to work. It might be in the US, it might be in Europe, it might be in Japan, it might be in China. Now, what's quite interesting is over the course of the last few years, we've seen this US bull market. It's got bigger and bigger and bigger for the last few years. And by the end of last year, MSCI US, which is a global benchmark, is 70% of the world. So the US is a big economy. It's the biggest economy in the world, but it does not represent 70% of the world, just 21% of GDP, yet the stock market is 70% of the world's stock market. And I would say that lots of global investors, having enjoyed that decent return in US equities, they're very tempted to look at redeploying that money somewhere else. Fund managers, they're not necessarily scientists, they're quite practical. And if something goes up, it's very easy to take a profit and then take that money and deploy it elsewhere. Now, a lot of cautious individuals might think, put that money into cash. But as Jesper identified in his opening remarks, inflation is now a big issue in the West. Even some retail prices in Japan are going up right now, which is alien to what Japan's been used to. And for that reason, putting money into cash means there's no returns, in fact, negative returns. One of the headlines I saw on Bloomberg the other day was cash is trash, which is a bit exaggerated, I guess, but it does tell you that in order to keep up with the pace of inflation, you need to put that money to work. Now, what we would advocate is that global investors take money out of the US and put it into Asia. Now, there's 2 or 3 things which global investors should be worried about. One is inflation. Another one is interest rates. Another one is geopolitics. There's a lot going on in the world right now with Russia, with Ukraine, with the US. And of course, there are flashpoints here in East Asia, which are not alien to investors in this part of the world. So I think our view is US market is incredibly expensive, although it's got some very exciting high-tech companies with decent track records in terms of growth. It is priced for perfection. We saw last week that one big TV streaming company, which I won't name, it missed its earnings and the share price dropped by 25%. We do not have that in Asia. Companies in Asia on the whole are very conservative. If you take the big geographies in terms of market value, it's China, it's Korea, it's Taiwan, it's Japan. Half of the listed companies out there are sitting with cash on the balance sheets. Now that's for a number of reasons. One is we had the Asia financial crisis back in 1997. Company managements are very conservative. And going back to some of the Confucian value sets, companies here in this part of the world are not leveraged to the same extent as those in the US. So if you take an interest rate hike, and it's very modest, we're still talking 1% sub in terms of the absolute number, but interest rates in absolute terms could double, which means that your financing costs actually double. And those companies with leverage, they don't happen to be in Asia, they happen to be in the West. So for that reason, we think that Asia is in good shape. If you're a global PM, you will look at something called a price earnings ratio, which gives you an indication of how expensive these markets are relative to each other. In the US, that's 22, 23 times. In Korea, it's sub 10. In Japan, it's about 13 times. And of course, in China, it's sub 10 as well. So Asia is a value market. The region also is characterized by some very exciting companies. If you take Taiwan, you take Korea, you've got TSMC, you've got Samsung Electronics. These are companies which have got characteristics not dissimilar to the US in terms of their prospects for growth, but actually are trading on very significant valuation discounts. So at Nomura, we are advocating a positive view on Asian markets going into 2022, and we're looking at double-digit returns, probably 18% during the calendar year. A couple of other things I wanted to mention, which I think are pertinent to the discussion we're having today. One is something called ESG. Now that's a real buzzword that we're hearing about these days by global investors. And E stands for environment, S is for social, and G is for governance. And I think there's a lot that Japan can teach the world about ESG. A lot of investors are very familiar with carbon zero targets, they're familiar with governance structures. But one of the things I think Japan is way ahead of other geographies is the way that Japan adopts this concept called stakeholder capitalism. Now, I'm sure a number of you have come across this concept called Sanpo Yoshi, which is a 3-way good. Companies are run not just for the shareholder, but for other stakeholders, including suppliers, including customers. If you keep your shareholders happy, keep your customers happy, and your suppliers happy, you have got a sustainable business. Another S word is sustainable, and Japan actually conforms to much of that. Now, one of the things which I think was very visible in Japan back in 2021 is a gentleman called Shibusawa-san. He was known as the father of Japanese capitalism, and I believe there was a feature program of him every Sunday night on one of the broadcasters. And in 2024, I believe his picture will be on the front of the 10,000 yen note. Now, Shibusawa-san, he advocated this concept called Gappon Shugi. And Gappon Shugi, often known as community capitalism or ethical capitalism, really takes the view that companies shouldn't just prioritize shareholders, but think about the wider ecosystem. Think about stakeholders such as society, think about your customers, your lending banks, and all parts of the ecosystem. And this is something which I think Western companies will learn a lot from. Now, if you go to Japan and you think about that legacy, go back to the 70s and 80s, lots of academics around the world were looking at Japan's model and thinking, how did Japan get it right? Jesper referenced the fact that we had the bubble in the Japanese economy in the late 1980s. Throughout the 70s and the 80s, lots of Western academics looked at Japan and asked, what did Japan get right? One of the things it did get right, of course, is to not just prioritize the shareholder, but to prioritize other stakeholders, including the employee. And there's a famous academic called James Abeglin. He did a study of American companies and Japanese companies and discovered American companies put the shareholder first and the Japanese companies put the employee first. So I think Japan will come into vogue throughout this year as ESG comes into vogue. The final thing I wanted to touch on is a risk for markets. And I think this is a very real risk, not just for Asian markets, but for markets all around the world. And that really relates to how do countries, societies pay for COVID. Now, if we go back to the GFC in 2007, 2008, 2009, the consequences were the rich got richer, the poor got poorer. And I can look at COVID-19, it's almost the same. In other words, stock markets have done incredibly well, investors have done well, people with good jobs have done well, the people who are part of the society that's been neglected have suffered. And for that reason, Gini coefficients around the region are at levels which I believe are unsustainable. Now, think about what's going on in China. You've got this concept called common prosperity. And when the Chinese want to do something, they just do it because we don't have the systems. You don't have to push a bill through Congress. You just get it done. Look at what's happening in the States. You've got people like Biden saying he wants to make billionaires cry. We'll look at the UK and Boris Johnson, if he makes it through the next couple of days, he's talked about this whole concept of leveling up. But also in Asia, this is happening. Korea, right now, as Bill referenced, there's going to be an election in March. The most likely contender to win that election is putting in place a policy which will mean a universal basic income and also possibly a land tax. And I think many of you might have watched Squid Games, which I watched with interest over the last couple of months. And it's very evident in these creative exports from Korea that it shows you the polarization of society. We had the same thing with a book called Pachinko, a similar thing with Parasite. You can see there's a coexistence of wealthy people along with those that simply don't have much wealth. And if you go to the most egalitarian society in Asia, which is probably Japan, we've even got issues there, where for the first time in 40 years, I believe one of the major charities has started distributing food parcel to underprivileged children. Now, going back to Kishida, and he may not actually implement what he talked about pre his election, but one thing he did talk about was a different form of capitalism. And there were certain words which he said in his first parliamentary speech, where he indicated this idea of equality being one of the mandates that he was wanting to put into place. Now, what does all that mean for markets? Well, what it does mean is that when countries around the world want to tax, where do they take the tax from? Especially in democracies, the easiest place to take tax from are wealthy individuals, companies with strong balance sheets. There are plenty of those around East Asia. And from a stock market point of view, incremental tax is really feared by investors. So while we do like Asia relative to other markets globally, we would caveat that for East Asia in particular, this idea of addressing inequality could be a spanner in the works for equity markets around the region. So hopefully that gives you my 10 minutes, and very happy to move back to Bill.
Many thanks, Jim. That's been great. And it gives us a lot of hooks on which to lead a discussion. We will, I think, talk about the new capitalism of Mr. Kishida and all of that issue of the interplay, I think, between like the sort of stakeholder capitalism legacy and the new corporate metabolism that Jesper is identifying. But first, I think I'd just like to, I can't go on without mentioning COVID and just wishing to get both of you to give us your sort of framework thought upon the way in which COVID will affect or could affect matters this year. In particular, I suppose, starting with the closing of borders. Maybe start with you, Jim, and then we'll go to Jesper about Japan. But there are a number of countries in Asia with still closed borders, and China, as the largest economy in the region, of course, is pursuing this zero COVID policy. Is there an economic price to that? How does that interplay with, if you like, market moves and economic prospects?
I think, Bill, if we concentrate on China, simply because it is the biggest single country in the region, I think if you'd asked the same question 20 years ago, the answer would be very different. One thing that we've been tracking over the course of the last few years is the composition of China's economy, and consumption or domestic consumption as a percentage of GDP in China. It is much, much higher now than it was, let's say, 20 years ago. The key driver for the Chinese economy was exports. Today, China relies not on the US or other geographies to prime its economy. It relies on its own domestic consumers. So I think what's quite interesting is if you look at Asian markets on the whole, you've got markets like Korea, you've got markets like Japan and Taiwan. Foreign investors own about 35 to 40% of those equity markets. In the case of China, it's less than 10%. Now, the other interesting thing about China is if you look at the big companies, and when someone asks you about an index, for example, what are you buying when you're buying China? You're not necessarily buying the China telecoms, the steel companies, the railway companies. You're actually buying tech companies. You're buying companies like JD.com. You're buying companies like Alibaba and Tencent. These are purely domestic companies that have very little interaction with the rest of the world. So oddly enough, again, if you're a portfolio manager and you want to diversify risk, then China is quite unique relative to other markets because the stock market is pretty much all domestically driven in terms of where that demand comes from. So I think there's clearly an ideological dispute, let's say, or ideological difference between how China's handling COVID relative to the West. I guess once we get through the Olympics in 2 or 3 months, then China will be more interested in opening up. But I sense that China now has got that confidence that if you go back to the Middle Kingdom of the 1850s, I mean, China thinks, 150 years ago, 170 years ago, it had its place in the world. And I think China is quietly confident that it has still a place in the world, which is very different from other geographies. So COVID, there are clearly restrictions. I'm here in Hong Kong. I find it very difficult to get back and forward to Europe where my family is, but it's a consequence that many people are having to pay. But ultimately, I think as we transition back to more freedom of labor and capital, then China's, the end impact has been very modest because of the change in China's composition of GDP.
Thank you. No, that's a very, very important point. Jesper, Japan, when will Japan open its borders, and is it paying an economic price for having closed borders, or is it more a sort of soft power and kind of intellectual price?
Look, I mean, God, I really had hoped that we could spend this hour without talking about COVID, but since you insist, number one, I think on the specific question of opening the borders, I think that unfortunately this will still be some time. I was 10 days ago, 12 days ago, I was at the Prime Minister's office, and they were high-fiving themselves, because popularity of Kishida, as you may have seen, has jumped by about 12 percentage points. And the primary reason is that he's so tough on COVID. But actually, the primary signaling that gets the popularity up is the fact that, wow, we are tough on the borders. We've closed the borders, quite radically with the quarantines, et cetera, et cetera. So I think for domestic policy expediency, I think it's going to be quite a ways. I can tell you, living here in Japan, it is absolutely enjoyable. My day-to-day life has not changed. The good news is, and this is where it gets interesting, 2 things on COVID. Number one, very importantly, COVID has been a catalyst, a welcome crisis for corporate leaders to do the things that they always knew they had to do, but they couldn't get done because of some legacy issue. So, for example, this change in the work-life balance is now very real. You can now have just a Zoom call, even with the bastions of conservatism, like Nippon Life Insurance, for example, which would have been impossible. I mean, they wouldn't even accept an email. You had to show up in person to sort of tell them that your GDP forecast is XYZ or whatever it was. So I think this catalyst for change in terms of taking away entrenched patterns of behavior, I think has been very important. The second thing that has happened because of COVID is that you actually have the business investment, right? Spending for growth here in the domestic economy, because you do need to build new centers, new distribution centers, and that's being compounded by the DX, by the digitalization strategy that the government is enforcing. So corporate Japan is actually becoming more capital intensive. And if you look at the key driver of GDP, it's business investment and exports. And the business investment expenditure side is the really the exciting part. Now, the bad part, Bill, and this is where unfortunately the legacy comes in, is that you've had obviously a lot of support policies, right? That with government grants and government support measures kicking in, the problem is that while disposable income is now slightly above, about 1% of GDP above where it was before COVID, disposable income, but you find that consumption spending is down about 5 percentage points from before where COVID started. And so there's no question, right, that there is anxiety and fear, right? But we also need to look at the reality. It's nice to blame COVID on anything. And if I were a politician, I certainly would. But at the same time, you and I are analysts, we're pragmatists, we're supposed to give advice. If you look at the data, there's actually something much more worrisome, which is the fact that actually in Japan, the entitlements are being cut back. So, for example, Prime Minister Suga, one of the reasons for why he was unpopular is, yes, thank you, he did increase out-of-pocket expense for Medicare, right, on the basis of means testing, and for anybody who is older than 72. You increase out-of-pocket expense for people who are over 72. And by the way, just to remind everybody, I am living here in Japan. I love it, but 1 in 4 Japanese in 2 years' time is going to be over the age of 70. So the demographic reality is absolutely real. But what the government has actually done, if you look at the data, right, on the income side of national income, you actually find that what the people receive from the government, right, is actually falling further and further behind from what they are paying in. And that was part of actually the latter years of Abe, as well as Suga, and Prime Minister Kishida is doing exactly the same thing. They've just announced that the pension payouts are going to be cut by 0.4%, which, is, reasonably significant, coming through. So that's if that sort of answers your question in a roundabout way.
Absolutely, and I'm delighted you managed to speak about a lot of things other than COVID in that answer, which was perfect as well. No, I think that's fascinating, and it does. And I'll come over to, Jim. One thing that always worries me in the with the concept of, if you like, the Shibusawa-san sort of image of Japan and the stakeholder market, which, in a way, although it's public sector, the things that Jesper has just been mentioning about these cuts and the extra costs being laid on people is part of. The part that worries me is the 40% of the labor force that are on non-regular contracts and part-time, less protected. This is a lot of the reason why wages have been so soft, that actually Japan has been, like, theoretically a stakeholder capitalist society, but also a cheap labor society. In many ways. And I wonder, Jim, if you see that as a contradiction to the...
I guess it kind of can be, but you've got to be mindful that Japanese companies were very heavily criticized by shareholders from about the beginning or the mid-1990s. So while we had these bunch of academics and management gurus trying to identify what is the secret sauce of Japanese company management, they were all over them in the 70s and in the 80s. And then there was a real reverse course back at the beginning of the 1990s when equity market returns turned down. So I did a bit of work back in 2010 where I interviewed a bunch of UK-based fund managers to get an understanding of what it was like to run Japanese equity portfolios as part of a UK asset manager. And these were tough times. Investors just did not want to know Japan. So I think a lot of investors put a lot of pressure on Japanese management to change the way that companies were run. And if you look at the labor force in Japan, we've got this lifetime employment, we've got this seniority-based pay, but we've also got this coexistence of individuals not in these circumstances. And I think that has risen directly as a consequence of those interactions with shareholders back in the 1990s, let's say in the last 25 years. So the situation has evolved not through, let's say, indigenous ideology, but perhaps perhaps from pressure from Western style investors. And be mindful that for Japan, up to half of the equity market is held by foreigners. And in many cases, some companies, you've got 70-75% of investors who are sitting outside of Japan. And they've been putting pressure on managements to change this very difficult, not difficult structure, but very rigid structure of having so many employees on fixed term or long-term contracts within the organization. So I think in many ways, the kind of state shareholder capitalism model, which emanates from Friedman and the US, has perhaps actually accelerated that trend in Japan.
Can I interchime on that
Yes.
for 30 seconds? You know, I mean, first of all, if you look at, okay, what do Japanese companies do with their profits? You know, yes, you know, dividends, yes, share buybacks. But actually, if you look at the reality, you know, because, you know, cash flow and earnings have risen so dramatically, actually, the only thing that has structurally grown and has changed from its past trends, well before all these governance reforms, is Naibu is retained earnings. So I am very much in the camp. I'm very optimistic on Japan, but in terms of you know, corporate governance and management, you know, running incredibly inefficient you know, capital structures and not at all paying out to labor. If you look at the OECD data in terms of, you know, corporate value add, how much goes to workers' compensation, you know, Japan is the lowest, you know, far below the United States of America. So on that, I think, you know, there's a lot of things that one needs to talk about. Now on ESG, and sorry, one other thing, Bill, it's very, very interesting. You know, you are right. Since labor market reform in 1996, the only net job creation was part-time jobs, surging from basically 20% to about 40% of all of employment. This has flipped over the last 5 years, and you're now actually seeing leading companies like Toyota, like Hitachi, actually hiring contract and part-time workers on a full-time basis. And it's very interesting, over the last 2 years, during the COVID crisis, you actually find that you know, full-time employment has continued to grow by about 1.6 million people. So the tightness in the labor market, the war for talent, is now actually changing the way the overall structure works. The single biggest drag on wages is the fact that Mick Jagger is retiring, is the fact that the baby boom generation is actually, you know, they've long left the leading companies, they work for the Staoke, they work for the smaller companies now, and now they're actually retiring. That's the biggest drag that you actually have on incomes. And finally, sorry, I don't mean to rant, but on ESG, I mean, I absolutely love it. My cynical friends in the more punchy parts of the investment world, you know what ESG stands for? Everything sounds good. The reality is that Japan embraces this, and it is a full level discussion now, and it is absolutely wonderful as a tool of engaging with corporate leaders. However, the key reality is that you need to have a corporate growth strategy. You know, Toshiba is, you know, continues to be, you know, a basket case, right? Not because of they don't talk about ESG, but because they simply do not have a growth strategy. You know, Toyota, you know, basically changed the perception in global markets over the last 3 months, precisely because, wow, after saying you're not going to do electric vehicles, now you're promising to go 1/3 of your production EV, and it's not just talk, because you open the curtain and there's 15 models that are there. So corporate Japan needs a growth strategy, and that, I think, continues to be the most important thing that you actually have. And that's actually a risk that I see. You know, the big political change, the big policy change over the last 3 years has been economic national security. Right, for whatever reasons that one can discuss, led obviously by the United States, sparked obviously, you know, by concerns over the People's Republic of China. This here in Japan is the single biggest new policy initiative that actually has been taken. And as you know, the tightening of the foreign exchange law, right, has actually become an obstacle, particularly for some of the up and coming asset management companies, because the cost of doing business here in Japan in the equity market for non-Japanese players, has actually gone up. So that's sort of what I wanted to say there. Be optimistic, but also be very, very careful. Japan is brilliant at spinning a story, while in reality, it is a very, very harsh form of conglomerate capitalism.
Very salutary. Thank you, Jesper. Now let me pick up a couple of questions which both of you can address. Duncan Bartlett and then also an anonymous question coming in, both asking about the new capitalism committee, the concept of new capitalism. What, if it can be really given reality, what can it consist of? Let's take the outsider view first from Jim. What are you and your colleagues thinking is actually likely to come out of this in policy terms?
Okay, so we are doing quite a bit of work on this at Nomura, and we're working with a gentleman who I think is in the audience today, who's at the Department of Japanese Studies at the University of Sheffield, Peter Matanley, and he is an expert on Japanese employment practices. What we found quite interesting recently is there was a study by the Harvard Law School, which came out in the middle of last year, which talked about the idea that Western shareholders were beginning to agitate portfolio companies to do things a little bit differently. Now, in the past, Western investors, and the two I'm referring to is Schroders, big UK asset manager, the other one's Legal & General, they had always put the shareholder first. So the Friedman doctrine, so to speak, was just concern yourself with the shareholder as an equity issuer, and the rest will sort itself out. But specifically during the COVID-19 pandemic, i.e. during the last 2 years, in the engagements these two large institutional investors have had with portfolio companies, they have advocated that portfolio companies prioritize the employee before the shareholder. Now that is a complete reverse course. And I think this is here to stay. And if you think about BlackRock, the biggest asset manager globally, the CEO or the chairman has made some global pronouncements about how companies have got these responsibilities beyond the shareholder. In today's Financial Times, there's an article by the former CEO of Unilever, who is as a proponent of the same thing, that companies have got these other responsibilities. So I do think that in Asia, Japan stands out as being slightly different from other geographies. Korea has got some parallels in the way that Korea kind of followed the developmental state that we had in Japan, strategic industries, large numbers of employees who are tied to the company. But on the whole, if you're looking for best practice in terms of ESG, as Jesper said, Japan is quite a good model. And the one thing I've discovered is that the E is quite easy to define, the G is quite easy to define, S, which I've called the middle child syndrome. It's quite a woolly concept, but I think over the course of the next few years, I think Japan's got an opportunity to showcase itself to the rest of the world and how it deals with that particular challenge.
Thank you. Jesper, what are you expecting? What are the possibilities?
From the new capitalism, it's we can gossip a little bit, because Kishida is an incredibly Machiavellian actor, let me tell you two anecdotes. The first one is that the moment he becomes elected, so they stand on the stage with Kono, and literally 8 minutes later he goes, "Oi, Kono-kun. Hey, Mr. Kono, right? You are now going to be in charge of PR on the public stage." This is not done in Japan. You don't do this. You don't send your brethren from the LDP into Siberia, which is exactly what has happened. And that's a very strong power move. So never, ever underestimate the hunger for power that Prime Minister Kishida has. New capitalism is primarily a response to the misgivings about Abenomics, right? When Abe started, Japan was in utter crisis. It was really, there is no alternative. We got to do wild and crazy things, which is exactly what they did. But Lord and behold, the various Gini coefficients, the Wells coefficients, etc., began to rise, and there was something that prompted even Abe. You may recall, 2 years before he stepped down, his speech at Davos was, "I want to go down in history as the gap buster." Right? It's a very strong allergy, because within the LDP, there is a deeply ingrained feeling that they lost power to the Democrats in the 1990s. When was it? In the year 2000s, they lost power because of the rising gap. Here in Japan. So from that perspective, Kishida is a populist in terms of the slogan that he actually has created. In terms of actually addressing things in the sense of raising capital gains taxes, remember that was the initial fear. Oh my God, we're going to have a capital gains tax in Japan. The stock market falls by 1,000 points, and Kishida is on the next morning show and says, no, on my term, we will not raise capital gains taxes. So I do not expect, sort of significant changes in tax policy coming through. Where there is a huge consensus here in Japan, and I think Japan will lead this way, and not through tax, but through cutting entitlements, by moving towards a means-based and possibly asset-based means testing, so that, for example, if your net financial wealth is more than, pick a number, 10 million yen, and you have no mortgage debt, your out-of-pocket expense for the medical, goes up to 50%, 60%, et cetera, et cetera. And then the second priority in terms of the redistribution is going to be to actually make the government more efficient. That's where the digitalization becomes very, very important, in the sense of that there are a lot of redundant, government procedures, particularly in the medical arena here in Japan, bringing this together, pulling this together, and eking out efficiency of spending. I think you're going to see a lot more of that. The third point is, whatever you do, do not invest in Japanese pharmaceutical or biotech companies. And the reason is that this is a regulated price, and the government relentlessly will cut and cut and cut. So how do I redistribute corporate profits? How do I overcome the Piketty problem, or the Karl Marx problem, that capital earns more than labor, right, over generations? In Japan, this happens through social policy, where you actually force price cuts, in de facto regulated markets. And by the way, it's quite interesting. I mean, you can debate this until you're blue, but on my numbers, basically about 1/3 of the Japanese consumer price index is actually regulated by the government, de facto price fixing by the government. And you remember Prime Minister Suga, shaming the telecommunications companies to cut telecommunications prices by 20%. I mean, I love it as a consumer. Now, I'm not investing in Japanese telecom companies, right? And so this is, I think, this idea of common social capital, that there is healthcare, that there is telecommunications, that there is education, that's where I think, Japan, basically follows this hybrid model. The Communist Party of late, has made some statements in the education system, for example, doing this as well. But Japan is this hybrid model of, yes, the government enforces price measures, is not afraid to redistribute out of profits into the purchasing power of the people. This is not going to happen via taxes, but via, increased price pressures.
Fascinating, yes. Now let me pop a couple of questions that have been put on by our audience for Jim. One on China and one on Japan, actually, though they're not unrelated. But Claire Weaver has asked one about Japan. To you, Jim, where does Nomura see business growth for Japanese financial institutions domestically over the next 12 to 18 months? What competition expected from new financial fintechs and blockchain companies? And the second question is about how exposed Japan is to the property market in China. But I'll come to that after you've answered the financial, the growth, domestic growth for financial institutions.
So I can give you two views. I can give you a Nomura view, and I can give you my view. But I want to preempt giving you the view that Aoki-san, who is the vice chairman of Nomura Europe, is also on this call. So I've got to be cautious on how I communicate. But I think it's fairly clear that there is going to be, or will be at some point, some consolidation of the banking space in Japan. Like other geographies, there are a number of regional banks which are probably existing with too many branches, too many employees. There are efficiency gains. So I think a consolidation story amongst the financials is likely. I think the second thing to mention, and I spoke to our regional banks analyst in Tokyo this morning, Takamaya-san, and one thing he mentioned, that if you are investing in Japanese banks, they typically are quite a good inflation hedge. So if you are an investor and you are concerned about inflation, there are certain ways you can mitigate that. One is you look at companies that can pass on price rises to consumers. Another thing you can look at is companies that can grow their dividends at a faster rate than inflation. Or in the case of Japanese banks, what Ken is saying is that there is a performance correlation between Japanese banks and the long bond yield in the US, which, given the interest rate pressure we're seeing in the US right now, would suggest that Japanese banks outperform. I think in terms of exposure to China on Japanese property, again, I think that's something which we leave for the specialists. But in terms of China and the way it's handled the recent property scandal, or whatever you might want to call it, Evergrande, which of course is this big equity issuer with a huge amount of, let's say, debt, which is not necessarily going to be repaid. I think what China's trying to do is to try and show that the moral hazard that we saw in the US with the banking space in 2008 and 2009, where the government came in as the lender of last resort, or the shareholder of last resort, or the recapitalization of last resort. I think China wants to show that actually it may not necessarily move in that direction, because that is something which will differentiate China from US markets. And I think China's trying to show that its style of capitalism does not tolerate some of the misdeeds that have taken place in Western markets. And specifically, we've seen some of the policy initiatives by Xi in terms of this common prosperity also intervening in the stock market in the same way as Jesper referred to in the Japanese regulator cutting mobile prices. China's done the same thing. It's really put curbs in place in terms of education providers. It's put curbs in place in terms of the big gaming companies, so Tencent and Alibaba, which are 35% of the local stock market, in terms of how users can pay and interact with these companies. So China is very active as an influencer, not just on the economy, but on the stock market through these policy measures.
Now, let's just have, thank you, Jim. Let's just have a couple of questions that are on demography, which is something that you, Jesper, mentioned earlier by citing Mick Jagger, but also other Japan-related phenomena. Yumio Yamamoto has asked how, given the realities of the over 70s demographics in Japan and lack of opportunities in all sorts of ways for those in their 20s and 30s, how does this bear on your Japan optimism? And another questioner has asked, lost it now, Akis Karianis, some talk about the record low number of Japanese citizens turning 20. Is this an impediment to long-term growth in the Nikkei going forward? And one might then apply that to the Republic of Korea as well, these analyses. How does demography fit in to your optimism?
Well, Bill, as you know, I want to be reborn as a 23-year-old Japanese, because it's now my market. And the number of university and high school graduates is dropping every year at the moment by about 45,000 kids. And as a result of that, it's now a buyer's market. And it is very interesting that you see, number one, you don't see the wage growth there. Starting salaries are still where they were, 10, 15, 20 years ago. But the quality of contracts, is actually improving quite significantly. And the next step, I think, is that this pay for performance, is actually happening there. It's a tougher world, because you've got to show that you're worth it. There's absolutely no question about that. One of the things that happened with COVID, because all of a sudden you can't hide by being in the office from 9 to 5. All of a sudden, you're not just on the Zoom call, but now every Japanese corporation has installed, software that actually measures the productivity. So how many phone calls, dear salesman, did you actually make? Which was unheard of before, So from that perspective, yes, it's a more competitive world, but I think that for the young end of the population, right, this is fantastic, and I am on record. I do believe that Japan will be the only advanced industrial economy where we are seeing the rise of a new middle class. And by the way, you can show this. We talked at the beginning about real estate prices. If you look at who takes out the mortgages, it is actually people in their late 20s and mid 30s. That's where the growth is coming from. They're now getting full-time jobs. They're getting stability of income. They're getting access to credit. Now, the bad part, as it were, is, of course, the Mick Jagger generation. But no, they're not. This is the richest baby boom generation on Earth. 70% of all the net financial assets are owned by people who are over 60 here in Japan. Between now and the next 10 years, I was going to say between now and the time Germany wins the World Cup, but that obviously is going to be this year. But no, between now and 2030, you will find the equivalent, and the numbers are a bit weird, somewhere between 400 and 600 trillion yen of assets will become unstuck because of inheritance, right? And that flow, ultimately generates jobs, et cetera, et cetera. There's a policy issue, because if you look at the average age of people who inherit money, unfortunately, they're 62 years old. So that doesn't do a lot, for the younger generation. But that's, I think, when you really think about the redistribution policy, the demographics here is actually a bond. It's actually fantastic, because Japan got very rich before it got old.
Now, we're running a bit out of time, so I'm going to jump to a last question or two, but I'll just mention what some others have said. Martin Barrow has said he's in the optimist club too. He's wanting a Japanese plan for rebuilding tourism in collaboration with other countries of East Asia, which comes back to that border question. Harry Wilby has asked, is this the decade that Japan breaks its status as a value trap, which the optimistic view and the changing corporate metabolism might suggest could happen. Takeshi Hajiro from Mitsui & Co. Has asked, what's the chance of Japanese companies succeeding in breaking into the Japanese market? Yuichiro Nakajima has asked about whether, in the opposite direction, Japanese companies will continue to be emphasizing outbound acquisitions and growth. I just wanted to mention those before introducing, as our final question, one from Lyric Hale, who has asked, what can go wrong? Is it COVID eventually catches up with Japan? Is it the PLA invades Taiwan? Given perceived US weakness, do you see Japan becoming more of a military power? In short, what are the things that keep you slightly less optimistic because you're aware of the long tail risks that could come? Jim first, and then Jesper.
Yeah, so I think the comments you made, Bill, about Japan perhaps being a value trap are quite relevant right now, because the stock market in the last 4 weeks has rotated away from growth into value. And some of these really beaten up stocks, I'll give you an example, British American Tobacco in the UK, it's up about 14% so far this year. And out of favor stock, very cheap, but back into favor now because of that valuation. I think one interesting piece of work that we've done recently is to look at Japan from a dividend yield perspective. And Japan historically paid dividends, but the dividends were modest in relation to the market capitalizations of the company. And as a consequence, the dividend yield was quite modest. I think about 2 or 3 years ago, Japan actually, because of the relative underperformance compared to the US, its dividend yield actually started to be bigger than what we saw in the US. And that's still the case right now. Now, one thing which I find is quite interesting is if you think about pension funds all over the world, they are obliged to pay out policyholders every year a certain annuity income. And linked to that annuity income, there is a growth requirement often to keep up with inflation. So if you are a global fund manager and you've got liabilities to service, then you want to buy a bunch of assets that can grow income every year, possibly faster than inflation. And that's where I think Japan is actually in quite good shape, because the dividend growth we've seen from Japan has been double-digit over the course of the last 7 years, I believe. And one thing that's interesting is that unlike those companies in the West, which have had to cut dividends during the COVID period, Japan has had that insulation from a capital point of view. It's got strong balance sheets. So despite the fact that short-term profits have come under pressure, it can use its balance sheet to ride out that dividend progression. So I think Japan looks good from that perspective. And I think that value is quite interesting. I think in terms of what could go wrong, and I'm sure Jesper will have some strong views on this as well, but one thing that I think will possibly be an issue for Japan this year is, what does Kishida do in terms of tax? Now, Jesper talked about this Machiavellian nature, and of course he did a bit of a reverse course when he got into Prime Minister's office. But one thing I picked up from the BBC is that during his first parliamentary address, he used this word called bunpei, or distribute, 12 times during that particular policy speech. And that, I think, is indicative of one thing he may consider is taxing investors, taxing corporates, which could have negative consequences for the stock market.
Thank you. Jesper, last word to you in in a minute or two, stealing from our audience.
Okay. Look, it's all these things about geopolitics, obviously, right? I mean, you don't want to see an invasion of Taiwan here. What am I worried about? Number one is the yen going to 95. Everybody and their brother is telling me that the rising interest rate differential is somehow going to pull the currency even weaker, and whether it's 120 or 125 or whatever it is. But I think that if you actually look at the empirical data, the moment the Fed starts to hike, the yen actually tends to strengthen. So there is a risk. I think that if the yen were to appreciate again, you have a policy conundrum from the Bank of Japan. What is it that they're going to be doing? The second risk is also on the currency side, which is the People's Republic of China being forced to actually devalue its currency. If China, because of the domestic deflationary pressures, for some reason actually abandons its strong renminbi policy or its stable renminbi policy, then I think this becomes an issue. If you look at the competitive matrix, 30 years ago, Japan was not competing with China. Now Japan competes in the Shinkansen bullet train market with the People's Republic of China, just to use one example there. So a currency war in Asia, I think, would be a big worry. Final worry, Bill, is that corporate Japan is not bold enough. Let me give you an example. Japan now is concerned about semiconductor independence. Fine, that's nice. And thank you, as a shareholder of Sony, I'm very happy that Sony got TSMC to commit to building a new fab here in Japan, which basically is $8 billion, of which $6 billion will be paid for by the government. So I'm a happy shareholder because getting something that's 8 for 2 is not a bad thing. The problem is that the People's Republic of China, between now and 2025, if I got this right, will spend $800 billion to build semiconductor factories. So you need to have scale. And if you look at outside of the car industry and a couple of industries, like, for example, air conditioners with Dicon, spindle motors with Nidec, etc., there's some niches, right? But overall, the scale of ambition, the scale of capital commitments to actually operate at scale, which is the scale that we operate with today. And the latest example, obviously, was also in the case of video gaming, right, with Microsoft's acquisition, that certainly is going to put some question marks over how big the ambitions of Sony are actually going to be.
Very powerful point. Thank you so much to both of you, Jesper Koll and Jim McCafferty. I apologize to the audience that I've both stolen 4 minutes of your time, but also failed to get to questions about climate, and all sorts of other questions about economic policy and others. Some great questions were there, but we had a great discussion too from you, Jim, and you, Jesper. Thank you so much for spending your time with us. It's a very stimulating start to the year, and let's talk again beginning of next year and see how things worked, but also how things have changed. So thank you to you, Jesper Koll. Thank you to you, Jim McCafferty, and good night to everyone, or good afternoon to everyone, depending on where you are. Bye-bye.
Sayonara.